please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Good morning. Welcome to Bazaar Morning Call. I'm Lata and with me Anuj and Sonia. Well, we're all soberly dressed in red and white, but the markets really are extremely confusing at this point in time. If you're looking for good news, there is, for the first time in how many decades, have North and South Korea decided to meet at the border, and almost a denuclearization has been promised. That can be extremely good news, and Asian markets are not doing badly for that. But on the other hand, you have news that Gary Cohn, someone who would have stood against protectionism, has resigned, and that could create future turmoil. But the Indian markets have long since stopped reacting to positive news from global markets. We have fallen under our own steam. Yesterday we fell without any bad news and without any help from global markets. So there's really no point looking for global cues now. We'll have to wait to see where this selling stops. Yesterday we had a positive FII number. Whether we should cling to that, whether 10,120, the 200-day moving average, will be some kind of a support, is what we have to look for. Good morning, both of you.
Hi, good morning, Lata. Good morning, Anuj. There are two sides to this Gary Cohn argument, right? If you read across the papers, on one hand, people believe that one man cannot really change the fortunes of the Economic Advisory Council, and on the other hand, most believe that Gary Cohn was the most level-headed architect of the Economic Council. So now with him gone, perhaps the risk of a trade war is more elevated, but we'll have to see. For now, the global markets are reacting to that. Anuj, morning. What's the sense you're getting about the market itself? We are this close to that 200 DMA. Do you get a sense that that could be violated very soon?
Morning, Sonia.
Violated very soon?
Morning, Sonia. Maybe not soon, but it will be at some point. Look, I think I made this point yesterday as well. We need to now stop our obsession with overnight Dow and all. It's absolutely useless because the market is charting its own course. Look at this year, and I'm not even comparing our market to US. MSCI Asia ex Japan is up 1.3%. MSCI Emerging Market Index is up 3.2%. MSCI India is down 5.6%. There's a 9% underperformance compared to emerging market, and portfolios are bleeding. The mid-cap index is down 10%. This works both ways. Last year, the mid-cap index was up 48%. Yeah. All of everyone thought that we are doing great. Our portfolios are wonderful. We all felt good about our mutual fund NAVs, right? But that if index is down 10%, you know what's happening with the individual portfolios. My base case today, and this is just for today, and I could go wrong, and I reserve the right of being wrong, is that after maybe a bit of knee-jerk volatility in the first half, today you could have a short covering rally in the second half. That may not mean much, but in the larger context of things, but the market is net short. And yesterday what would have happened was, in that last free fall that happened, a lot of weak bears would have entered into the market, who would have shorted right at the bottom. And if they don't get enough follow through, in that case, the market could see some covering. Again, the point here is you're 120 points away from the 200-day moving average on the Nifty. And the first test of 200-day moving average, as we saw even with the Bank Nifty, the first test is defended. There's a second test which normally is sliced through, again, like we saw with Bank Nifty. But if you open, say, 100 points above the 200-day moving average on the Nifty, in that case, your stop loss is very close if you're attempting a long trade. So there could be some short covering bounce in the second half today, again, which may not mean much, may not change the texture of this market. Ultimately, you are headed towards the 200-day moving average. One good thing, one thing which has happened over the last few days, and we spoke about it earlier as well, look at the financials weight in the Nifty now. It's down to 35% from 42%. Last time the Nifty was at 10,276, the Bank Nifty was easily 1,000 points above that. And now you've seen that decline. And IT's weight in index is up from 9% to 13%. I think this is one way of markets moving that weight from banks to IT. When one sector goes to 40-42%, it's unsustainable. It's healthy for the market. This is a bull market correction. It will end at some point. But for now, there's some more pain left in the system. Probably up until 31st March, when the LTCG bogey would be out of the way, and then from next financial year, probably you start afresh.
Okay. No, I really cannot comment on all these technical issues of how the LTCG selling and buying and rebalancing your portfolio might work. But clearly the financial pain, perhaps pain for the finances, is something which the market was really acting blind to. The mark-to-market losses because of higher bonds and the very severe February 12th circular, which is going to mean a huge amount of, earlier stressed loans now recognized as NPAs, was something that the market had to come to terms with. And it came to terms with it suddenly yesterday on the PSU Bank front. At what point it will stop? Even now, nobody is calling a buy on those stocks. So, we really will have to wait and see whether yesterday's fall was good enough. Was it a crunching fall? There's a gut-wrenching fall after that the market stops falling. Whether that already was yesterday or whether more is to come, we have to still wait and see.
Okay, well, let's do one thing. Let's get you some views on the money markets, and then we'll get some equity market comments coming in as well. First, on the money markets this morning, Pramit Brahmabhat of Veracity says the rupee will be under pressure on the back of FI outflow and negative cues from the domestic equity markets. He expects the spot dollar INR pair to trade in a range of 64.80 to 65.20. And Dhaval Dalal of Edelweiss talks about the bond market, says the bond yields continue to consolidate in the last few trading sessions amidst low trading volumes. He says market participants are watching if the 10-year benchmark bond yield makes another attempt to break past its previous peak of 7.81% anytime soon. He believes that bond yields should hold the current levels in absence of any negative news flow. February inflation should be lower than the January CPI. He expects the 10-year benchmark bond yield to remain in a range of 7.7 to 7.80% in the near term.
Okay, then over to Nigel for the world view.
Well, overnight, plenty of volatility in the U.S. markets. They managed to end in the green, but intraday, in fact, the Dow had moved nearly around 250 to around 280 points odd. Netflix, as well as Amazon, they outperformed there, and that's what led to the Nasdaq doing a relative outperformance in terms of the front three indices. Well, the markets have been on the edge because they're waiting by for what Donald Trump is going to do on tariffs. But yesterday, in fact, particularly post-market hours, we had a larger news that played off. Now, we had Gary Cohn that has resigned as, in fact, Donald Trump's economic advisor. And that was the news that was doing the rounds for the last couple of weeks. Now, post-markets, that did come about officially. And that's why, in fact, we did see the Dow was down nearly around 400 points. Actually, it's recovered a tad bit from the lows. Why is this important? Because remember, Gary Cohn, in fact, was the main person in terms of those tax cuts that got affected from December 2017 itself. Harley-Davidson was a stock that was under pressure. They said that if in case this tariff war does break out, then it's going to impact their sales numbers going ahead as well. In terms of economic data, well, we had some weak economic data that came in there, but not unexpected, really. The factory orders as well as the durable goods orders, both of them did take a bit of a knock. That's unlikely to change the Fed stance going ahead as well. European markets, well, they managed to eke out some gains in yesterday's trading session. They ended with gains of around 0.2 to around 0.4%. But the Italian index, that bounced back. Remember, it took a sharp knock in the previous trading session. Now, there are some hopes that, in fact, the numbers can come together and they can form a stable government over there. So keep an eye out on that one. Auto stocks as well, they bounced back. They got hit in the previous trading session. We had Volkswagen that did well. The monthly sales numbers look good. Fiat, there was a corporate restructuring over there, so that as well did bounce back. Asian markets, they're off the lows that we saw earlier today, and the SGX Nifty as well is now indicating a flattish start.
Okay, thank you very much for that, Nigel. On a normal day, the Korean story would have been very, very big, but we have got rival bad news from the US, and that's the big story this morning. The global landscape. White House Chief Economic Advisor Gary Cohn has resigned from President Trump's administration over the issue of import tariffs. As well, of course, as I told you, overnight, North Korea said it was open to talks with the US on denuclearization. Very, very important development. But in my own view, I think the domestic markets have decoupled, and now the Indian markets are moving under their own steam. Arvind Sangha, Managing Partner at Geosphere Capital Management, joins us now. Good morning, Arvind. There may be good and bad news globally, but India continues to fall. Do you think that there is more reason for the markets to fall, or they've fallen enough?
Well, I mean, I think India has its own challenges. And obviously, you were talking a few minutes ago about the bank situation, and that seems to have become the anchor that is driving the market lower. But the global situation has gotten a lot less favorable, and that too is causing a little bit of a pause in the liquidity flow that has been coming to the domestic market. So global investors are nervous about global cues. If global trade war is going to break out, then investment in global markets becomes less desirable or more dangerous, and therefore investors are pulling back a little bit from that. And then India itself is seeing some challenges, although it's ironic that the Indian earnings recovery and the economic recovery seems to be finally starting to move in the right direction, with all of the challenges of the last 12 to 15 months now in the rearview mirror. But global liquidity is a problem, and India banking situation keeps dragging out. And I think we're fundamentally more optimistic about India, including the bad loan situation, but the political situation in India also, notwithstanding the Northeast results, is going to be challenging this year because of concerns about, what the tea leaves are reading for the 2019 Lok Sabha election. So I think those are some of the reasons why the markets are probably, even in India, not likely to see any kind of a V-shaped recovery and likely to remain somewhat range-bound.
Okay, that's interesting. Arvind, good morning. And from the index point of view, the problem is that some of the urban consumption stocks and some of the financials have the highest weight in the index, and they have led the market rally. So this year, do you think the portfolio focus should be completely different, more towards rural stocks, more towards agri stocks?
I think rural and agri is an easy macro call to make, but I think there are other areas. Clearly, the road and infrastructure sector is an area where we could continue to see more action. The Bharatmala scheme, and then a lot of stuff going on in terms of urban infrastructure, in terms of metros and what have you, as well as potentially a lot going on in the affordable housing. So there are areas, and so I think even some of the NBFCs that are focusing on affordable housing, some of the companies that focus on that, as well as other infrastructure, could benefit. So, and I think the cyclical recovery, as it broadens out, it's been, I think there are many opportunities that are going to come to the front from a fundamental standpoint. I think the macro risks, both on the India political front and on the global macro front, are going to be a headwind. But on the other hand, I think the earnings fundamentals are likely to be more broad-based in a recovery sense. And even the IT sector, which has been, under a cloud, looks like might start to see some signs of stabilization and recovery, and that could be another area that could, continue to rebound from here.
Okay. Arvind, hi, good morning. You mentioned that you don't expect a V-shaped recovery for the Indian markets anytime soon, but do you believe that this is still a bull market correction, or have we entered into a bear market phase now?
I think it is a bull market correction, but the problem with bull market corrections is, they can be very short in duration, or they can be somewhat, dragged out, where hitting the previous highs might take, a couple of quarters. My view would be it's more the latter than the former. But in the end, we're looking for individual stocks that we should buy, and we're looking for, big sell-offs coming out in some of the stocks that we have our eye on. And they can be in a variety of sectors. But the reality is, I think that as an overall market, some of the market leaders are going to have challenges, and that could provide a bit of a headwind for the index to, to go back very quickly.
Okay, so at the moment, what's your sense? Having fallen, 1,000 points from the all-time highs, is it attractive? Are you a buyer right now?
I'm a buyer of individual stocks, and I think I'm finding one or two stocks that have gotten to our levels. There are others that are still a little further away. So I think the market, in our opinion, is not done chopping around in terms of a trading range. And our goal is not to be, we're not worried that the market's going to run away from us in terms of, us missing. So we're being somewhat patient in putting money to work, but we are starting to put money to work.
Okay. Are you a buyer in PNB or any other PSU bank?
Well, we did buy one PSU bank, but we were a little early, but it was luckily in small size. But on the other hand, we own some of the, NBFCs that have continued to do well, although they pulled back a little bit. And then we've nibbled, actually, we've owned one of the private sector bank that's in trouble. But, I think the Axis Bank, ICICI Bank concerns with the two CEOs getting called in terms of the whole PNB inquiry, I think is a bit of an overreaction. My sense is that this whole PNB situation will not drag the banking sector down in the way that the whole NPA situation has. This is a one-off, clearly a failure for PSU Bank, but I'm not rushing in and buying PSU banks, but I am looking at some of the private sector banks that have lagged and looking at opportunities.
Okay, I mean, I just have to set the record straight. The investigative agencies merely sent a letter to the two private sector banks you alluded to. The letter happened to be addressed to the MDs, but it was not the MDs who went in for the interrogation. It was DMDs and other senior officials. So, I mean, this, as you say, was probably incorrectly reported or incorrectly understood. We did try at CNBC TV18 to make it very clear that the letter was merely addressed to the MD, and it was not the MDs who went in for the interrogation. But anyway, that was a minor detail. You know, I wanted to also get your view on this Gary Cohn issue. We've spoken enough about India. Can, you know, the entire protectionism lead into any unraveling in global markets at all? Both Europe, despite what happened in Italy, and the US markets, Wall Street, have not reacted all that negatively. It was a one-day reaction.
Yeah, I think I'm really nervous about global markets because I think what President Trump is doing is playing with fire. And he thinks that by threatening other countries, others will back down. But there is a political dynamic to this threatening countries and asking them to back down, is that the other countries get their backs up and they have to show their voters that they're not kowtowing to the US. And what that can end up resulting in is a global unraveling of what has been a multi-decade growth in global trade. And if you do get a tariffs, tit-for-tat tariffs, and that escalates, and Europeans put tariffs on some US products, and then US retaliates by putting tariffs on European car imports, as President Trump has threatened, I think the risks here are really high. And frankly, Gary Cohn was one of the most prominent voices speaking in favor of global engagement, global trade, and not doing anything to hurt that. And his departure, in my opinion, raises the risks that miscalculation on both sides, and most probably on the US government side, leads to a trade war. And I think that would be hugely negative for global markets, because global markets have, we've had a 3 or 4 decade growth in global trade and fall in interest rates. If you look at a long cycle, both might be turning on a long-term basis from historic lows in interest rates and historic kind of high levels of global trade. Could we be turning negative in both? And if that turns out to be the case, then the markets are going to face greater headwinds than, frankly, what is so far a modest correction. So that's the one thing that gives us pause in global markets, is the risks of a trade war breaking out.
Okay, and Arvind, as they say, there are no winners in trade wars. In that case, if this escalates, could this be a case where everything is down, commodities are down, exporters are down, even commodity consuming companies are down? Could it be that kind of a year if this escalates?
Well, I mean, yes, all sectors could be hurt, but the biggest high flyers have been technology stocks. Now, technology stocks, in many cases, are also global companies. And I would not expect any global stocks to be left unscathed in a global trade war. And I think, unfortunately, one of the realities, and yes, so I think commodity sectors would not be immune to that. But commodity sectors are not what have led this market higher. And so far, we have not seen China retaliate yet. China has been playing, somewhat the adult in the room as compared to the U.S. in trade. And unfortunately, President Trump seems to have this long-held belief, going back 30 years, if you look at his old interviews, that somehow trade deficit means somebody else is taking advantage of you. And therefore, the risk is, with that deep-held belief, that he's going to continue to escalate this. And therefore, if China joins in terms of retaliation and Europe joins in terms of retaliation, the risks are that, certainly commodity sectors, but other sectors could get dragged down, and therefore the overall market could get...
Arvind, we always imagined this kind of a unraveling, even when Brexit happened, that, all of Europe will unravel. politicians are not so stupid. Will they wait for that? Will they not take damage control steps? Is there a case to buy this dip?
Well, you remember, Brexit was a bunch of voters who were upset about things and made the decision, but the leadership of that time and subsequent leadership of the UK government and of the other governments have been trying to minimize the effect of dislocation on trade. The problem you have in the US is that the leader of the US believes that free trade is bad. That is the first major leader in the world. Brexit was a bottom-up kind of a protest, but the leaders were more sane and adult, if I may call it that. Here you have a US president who is behaving, like the chief bomb thrower. And that, I think, is highly destabilizing. And that's the problem. It's not just the voters saying it, but it is, the president saying it. And that's what makes it so dangerous.
Okay. I just had one question on how to approach the Indian markets now in terms of large caps and mid caps, because the correction in the mid cap space has been really brutal so far. Do you think for the rest of the year, or at least for a major chunk of this year, it's better to stick to large caps, or would you still delve into some of the non-index large caps or the mid cap variety?
Well, I think at the end of the day, good companies are good companies, but I think you make an excellent point. Some of the mid cap valuations have gotten so extreme that I think one of the risks remains that in the sell-off, the mid-cap correction could be much larger. And although there might be a long-term story in many of the mid-caps, if you're going to play the rural plays, you're going to play some of the other plays that you were talking about. There are not too many large caps that give you exposure there, but I think if the risk is that the broader market is going to remain challenged and could go down, then some of the safer bets could be some of the large caps which will get sold off less because either the valuations are less stretched or there is less hot money to come out in those names. So I think in that sense, large caps would be better defensive stocks to own until we get a better sense that the market liquidity, and I think one of the things you have to watch is, how does the Indian liquidity, which has been a one-way street, how does that deal with this volatility? And we've already seen some flows slow down dramatically. So it'll be interesting to watch that. But that's one of the risk factors we're keeping an eye on.
All right.